Now let's try to understand about this unit linked contracts. Typically in the insurance policies, we keep hearing the word unit linked policies, wherein they might be associated either as a whole life policy or they might be associated as an endowment assurance kind of a policy. So if it is for a whole life, the death benefit is paid at the time of death. Endowment assurance typically contains a death benefit as well as a maturity benefit. But when I am talking about a unit linked contract, the benefit is directly linked to the investment and the value of the investment. So it need not be a guaranteed value, right? The whole benefit that a person is going to get either on death or on maturity is very much linked with the investment value of the contract. So what generally happens is every time you pay a premium, every time a premium is paid, a portion of the premium, this is where we try to split the portion of the premium as allocated premium and unallocated premium. So for the allocated, you see some percentage. Probably this may differ from year to year. Now, this particular allocated, whatever is the amount, that would be allocated towards investment, and it is allocated to what is called as a unit fund. So, based on whatever is the amount that is allocated to that unit fund, and based on the price that is available for that unit fund, every time some number of units will be purchased. And here the customer actually has a choice. The policy holder has a choice what kind of investment fund he wants to choose. So it is not a concept of pooling of investments. It is more and more of customized investment. Purely depend on the policy holder in what kind of fund he would like to invest. So that portion of the premium, which is called as allocated, is typically invested towards a unit fund, and the remaining unallocated is the one that is more targeted towards the death benefits and various other stuff, which might even take care of the expenses of the insurer. It might take care of the commissions of the insurer. It might also take care of the fund management charge. There are so many expenses that can come out of the unallocated. Even this contributes to the profit of the insurer. So typically whenever we talk about the unit linked, it is not a pooling of the investment, or it's not an allocation of the pooled surplus. So every time an individual is paying a premium, some portion, whatever is the allocated percentage, which would be mentioned as a part of the offer document, that is invested in a fund which the policy holder can choose, and that fund value will be divided into units based on the initial workout, and based on the price of the unit, the number of units are purchased based on the amount that has been allocated into it. So when every allocation, every year you are paying a premium, there is some allocation to the fund is happening, means the number of units that are purchased of that particular fund is increasing. Now what typically happens is, if the person has died, or in case of endowment assurance, if the person had survived a particular time period, the cumulative number of units purchased till date, whatever is the amount till date for the cumulative number of units that are purchased, that is the one that comes out as the sum assured under the policy, whether it is for death or for survival. But of course, some policies they try to give something more. They may put some kind of minimum sum assured where some guaranteed amount will come out to make sure that the policyholder really suffers, because the main intention of an insurance policy is to protect against the risk. Now, when we are trying to choose the unit linked, there is a big risk to the policyholder, because if the investments don't perform well, his sum assured is falling drastically. There is no guaranteed amount there. So if he is not aware of the kind of investments, probably he is going to lose very badly. And this is where, to prevent the policyholder from suffering because of the poor performance of the investments, there might be a minimum sum assured also that could be offered as a part of the policies. But if I am looking at the traditional unit linked kind of a policy, it's that whatever the kind of investment the policyholder has chosen, the part of the premium would be allocated to those investments. And whatever is the way that investment is growing, on the death or the survival of the person, the cumulative value of the units would typically be counted and would be paid to the policyholder. So it's specific. There is a separate account for each policyholder. He has a choice to decide what kind of investments he want that portion of the premium be allocated to. So typically, if I want to look at the pricing or the value of those kind of contracts, I need a very good clarity in terms of what is the allocation percentage they are doing in each of the years. Generally in the year one, it could be much lesser because of various expenses that are incurred at the beginning of the policy year. But on a continuous basis, there could be a different allocation percentage. And even I also require to understand at what growth rate, at what interest rate the investments are typically expected to grow. So as a terminology, what we generally see is, whenever I talk about my unit account, it is purely talking about the number of units that have been purchased till date of the fund and what is the value of that number of units at any point in time. And these insurers typically use what is called as a bid offer price. It is very simple. When you are paying a premium, that portion of the premium, I said that the portion of the premium they are going to buy the units of the fund. With that allocated portion, they are going to buy the units of the fund. Now they are going to buy it, which itself means you are going to buy it. You are going to buy the units of the fund at what is called as an offer price. Right? You are going to buy, or probably from your side, when you are buying, means they are trying to sell. The insurance company is trying to sell the units to you at an offer price. You are buying it at an offer price. And on the maturity, you had some number of units, right? Every year at some offer price, the units are getting purchased. So you have pulled up some number of units. Now let's say this is the year when either the death benefit or maturity benefit needs to be paid. So all your units will be bought back by the insurance company or bought back by the fund. So the price at which it is going to buy back is the typical bid price. And traditionally what you see is bid price will always be lesser than offer price, because bid price is the price at which the fund will be purchasing the units from us. Offer price is the price at which we are purchasing the units from the fund. So at every period we are purchasing the units at a higher price. we are selling back that units to the fund at a lower price. Generally, this spread is very much closer to around 5% in a regular basis. And apart from that, in this unit life brochures and document, you see different kinds of charges. Even from the unit account, from this account, on a day-to-day basis or on a annual basis, we see that the fund actually deducts some charges, which constitute your fund management charges, and it can change from period to period also. So your unit account value will sometimes keep falling because of the changes that are being brought about in it. So traditionally, if I have to look out for a simple diagram, whatever the premium that you are paying, two portions of it. One is the allocated, some portion of it is allocated, and some portion of it is unallocated. So this allocated portion, it will look at, it will consider the cost of allocation, and based on the cost of allocation, this entire amount is going into, taking out the cost of allocation, the remaining amount is going into the unit fund. And this, whatever the unit fund, the returns that it is giving, the benefits are typically paid to the policy holder. But on the other side, out of this allocated, we see there is a bid offer spread, because you are purchasing it at the offer price. The units you are purchasing at the offer price, but if you are selling it back, you are selling it at the bid price. So that spread actually belongs to the insurance company. So whatever is the bid offer spread that they have provided, along with the various unallocated premiums, this entire money goes into the non-unit fund, which is purely controlled by the insurance company, and the investor will not be, and the policy holder will not be able to have access to this. And from here, because it is creating a unit fund, it is charging. There are some charges associated with this unit fund as well. All these things are going into the non-unit fund. And this non-unit fund are purely working out for non-unit based benefits to the policyholder. If at all there is some kind of guaranteed payment, guaranteed death benefit or something like that, it is purely coming from the non-unit benefits. And this fund will always contribute to the expenses of the insurance company. So this is a typical way you can look at the how your premium, especially in case of unit linked policies, are traditionally handled. Now when you are looking at the unit fund, your fund is worth only the bid value, right? Because X number of units you have piled up, but when you are surrendering it, you are selling it back to the fund only at the bid value. So whatever is the number of units, you multiply it with the bid value of the allocated premium. That is what will be the value of the fund when the fund is typically or on the maturity or on the death benefit. The remaining portion is purely going into the non-unit fund. And when we are looking at the various charges, probably the fund management charge that is happening in terms of buying and selling that fund would be buying and selling some equities, buying and selling some bonds. So there are some fund management expenses that are associated with it. And whatever is the balance, whatever is the non-unit fund, after deducting all the expenses and after deducting any kind of non-unit benefits, the balancing item is what is the typical profit that goes to the insurance company. So from the external perspective, if I look at, or from a typical policyholder's perspective, if I look at, the unit fund is what the policyholder is seeing. The unit, how it is growing, only that is what is communicated to the policyholder. The non-unit portion of it is purely an activity that is going inside the insurance company. So the non-unit related data is not revealed to the typical to the typical policyholder. So this is what we really need to understand, because when we are investing in a unit linked life assurance policy, we are, as a policy holder, we are taking the risk of the investment returns. It's not the insurance company taking the risk on our behalf. Only if there is any kind of guaranteed benefit, only that portion is what is taken care by the insurance company. All right.